Welcome to PlotLines, where we'll use our over 30 years of experience in real estate communications to uncover the real stories behind real estate. I'm Heather Crowell.
And I'm Brittany Acriveau. Dive in with us as we invite guests to break down the ever-changing landscapes of real estate together.
Welcome back to PlotLines, everyone. Today we have Jim Paterno, CEO and founder of Stockton Real Estate Advisors. Jim, I've known you for quite some time. My co-host Brittany is just meeting you for the first time, so hoping you can tell us a little bit about Stockton Real Estate Advisors and your journey in CRE and starting the firm.
Hey, Heather and Brittany, thanks for having me. It's great to join you. So yes, Stockton Real Estate Advisors and SREA Property Management, which is our property management arm, have been in existence for almost 20 years. So we're really looking forward to celebrating our 20th anniversary in January.
That's great.
We are a boutique firm, 20 people, and as we flesh out our 20th anniversary story, 20 people, 20 years, 20 stories. So we're excited about telling the world about ourselves as we move into next year. But Stockton Real Estate Advisors is a firm that provides guidance to real estate owners and tenants and users of space, and a lot of work with nonprofits as well. So we're helping owners fill buildings, and we're helping tenants identify the right opportunities and navigate through some uncharted territory right now. SREA Property Management is our property management group that provides third party and as well as owned property management and asset management services, as well as distressed real estate and receivership work. So in addition to the advisory platform, we also are direct investors and co-investors in real estate here, primarily in Philadelphia, across a number of different asset classes.
That's great. Jim, you mentioned uncharted territories, and I think that bodes well to what Heather and I are trying to achieve here on the PlotLines podcast, right? So breaking down the headlines and what's out there and asking our guests to comment on it. Is it real? Is it inflated? Are we hearing the right stories? So I want to focus a little bit on the office market because we know that you have a big focus there. Wall Street Journal just put out an article yesterday about office loans defaulting to near historic levels with billions on the line. The article goes on to talk about the financial upheaval in the office market, and of course talk about the record vacancy rates that we're experiencing right now. So want to get your take on that. Is that what you're really feeling on your side? Is that what we're seeing? What are your thoughts there?
Yeah, it's funny, Brittany, that you mentioned that. I have the article in front of me.
Yeah.
I was going to cite that as the first area of concern. We are seeing tremendous pressure in the real estate market, particularly in the office sector, in troubled loans and troubled banks as well. Right. So the other headline, and it's kind of buried in here, but it's certainly something to keep note of and keep track of, is that a lot of these small local regional banks have significant exposure to commercial real estate loans. In fact, just this past Friday, we've all read about Republic First Bank being taken over by Fulton. That's the tip of another iceberg that's looming out there. Our experience has been, especially in our property management side, that we are being approached by more and more banks, more and more attorneys who represent lenders, expressing concern about their real estate loans and seeking some guidance and receivership expertise. And so that's an area that we've pivoted to in the last couple of years. We anticipated this actually about 3 years ago and brought in some really top-notch talent, people that were expert in real estate loan workouts.
Smart.
Because we knew this was coming. And interestingly, banks and lenders were able to kick this can down the road for a year or two and get through 2023. And we really thought that we would see a lot more of this last year. But, with Wall Street and earnings reporting and everything else, many companies are adept at moving things to another
Extend
quarter.
and pretend.
I think we're
they
at
say.
the point in the cycle where it's going to be tougher and tougher for lenders to continue to deal with that. So we've picked up 2 court-appointed receivership receiverships just in the last several months. We've turned down 2 others. We are being approached by several others at the moment to do more. And we see this as a snowballing effect. And receiverships are a very complex matter that try to find the balance in the fiduciary responsibility between a lender and a borrower and doing what's in the best interest of the shareholders.
Right. So tell us a little bit about that relationship, that receivership. Our listeners may not be as familiar, so maybe you can tell us a little bit about how that works and what your role is there. Right? Are you who are you representing, and what's the goal?
Sure, that's a great question. So typically, if a borrower starts to struggle or defaults with a loan, the lender has to try to recover as much of its value in that asset as possible. Many times there's concern that the borrower is not going to act in the best interest of the collateral because the borrower is in self-preservation mode. So the lender will ask the court to appoint an independent, objective third-party fiduciary to manage and care for that property until some conclusion can be arranged between the borrower and the lender. So the court actually will engage SREA property management. We report directly to the court. Our role is to protect the interests of all parties. If it's a multifamily property, we are concerned with not only the asset, but the residents and their safety and their well-being. And typically, we're giving broad powers to act in the best interest of that asset. So that may include repairs, it may include management decisions. It may include ultimately selling the asset to recoup as much value as possible for the lender.
Okay, so you mentioned multifamily in there. Fair to say that, where are you seeing the bulk of that activity, the receivership? I think we started anticipating it was in the office space, but
well, it is primarily in the office space right now. There's a significant degradation of value right now in office, as we can imagine, between hybrid work from home, permanent work from home, AI implications, which maybe we'll talk about in a couple of minutes. The whole landscape of the office environment is on its head. And so values are, rapidly declining. We're seeing value degradation of 40, 50, 60%, even more in some cases. So in those cases, the borrower is underwater. There's really no hope to kind of get themselves back to a profitable or even break-even status. Banks don't want those assets back because they don't have the skill set to handle them, and there's really no upside in the future there. So you have that. On the multifamily, you have a number of different situations. When the markets were booming, many smaller developers of multifamily started to ratchet up and take their development efforts to the next level. Maybe they stretched a little further. Maybe it was a first or second time developer who had some success on a small scale, decided to go big, got out over their skis, really didn't understand the process, overran their construction costs or their timing, got stuck in an interest rate environment where interest rates accelerated, and you had a short-term refi, and all of a sudden your nice rate went to something that was untenable. We've had 2 cases right now. One is a busted condo development where the owner was just not able to perform, and in the other case we have a low-income senior housing development or apartment complex in which the borrower really just a bad actor, and so in that case, we had to step in. But in a lot of cases, we're also seeing some overbuilding, and so as the multifamily market softens a bit, the numbers get tighter, and we anticipate there'll be some multifamily receivership work, although a fraction compared to really the office building situation.
Sure.
right.
Yeah, I want to shift gears just a little bit back to that office, Jim. So another article this week from Forbes, maybe you saw this one as well, called it the year of retention for tenants, and cited a stat from CBRE that 80% of office occupiers have adopted and will sustain the hybrid work policy. So that spells some good news. But the article went on to talk about how, in essence, office landlords and employers are now competing with the couch. And I thought that was an interesting way to put it. So what are some of the things that you're seeing, and even that Stockton's doing, to, try to keep luring tenants back to the office with these experiences?
It's really interesting as a real estate company and as an owner of real estate and a property manager. Other than the first few weeks of the pandemic, we've all been in every day. This is a hands-on business, and my personal philosophy is that if I'm asking my engineers and my team to be in the office and on site, then we need to lead by example and be there as well. Probably a little bit of an indicator of my age as well. I'm fully committed to being in an office, and I think there's tremendous value to culture and mentorship opportunities, and I think having an esprit de corps is critical. That being said, I think the cat is out of the bag. Work from home and hybrid work models are here to stay.
Absolutely.
The notion of competing with the couch, I don't know that anyone can ever win against the couch.
Not in my book.
There's certainly attempts to continue to amenitize space to try to attract and retain people, and it's wonderful that there's things like biophilic design, which is sensitivity to the natural environment, and a more of a wellness, health and a mental and general wellness perspective. There's a recognition of neurodiversity and how different people learn and process in different environments. So to have casual seating area and more heads down space, those things are all great, and I do think they're helpful. Today I was at the Center City District report on Philadelphia, and I'm on the Center City District Foundation board. So we take a very active role in trying to parse through return to work and activity and activation in the city. The office occupancy level is at about 80% right now, and we were at about 91%, and at the top of the market. So that's about a 4 million square foot degradation of occupancy. That has vast repercussions on street traffic and feelings of safety and quality of life, and supporting local retailers and service providers. That's really the challenge. I think that if you look at from 6 o'clock to 11 o'clock at night, city is booming. And we were talking this morning about the vibe, and the vibe is, if you come in from the suburbs and you're only coming to Market West, you're seeing an environment that is a fraction of what it used to be. If you live in town and you are working from home and you are in Northern Liberties or Passyunk and other spots, you're seeing this great activity, and this vibe is off the charts. We've got more people living in town now than we did before the pandemic. If you're out in the suburbs, deep in the suburbs, you're gonna read headlines that say, rogue ATV riders, or certain issues that are just challenging, and you're going to feel like you don't ever want to come back to the city. And so there's all these different perceptions. The greatest number of people that are working in their office are people that live close to the office. And so I think part of the message with the CCD and our board and our foundation, and I think a message here to answer your question, is that we need to do more to just, to accentuate the positive of being in Philadelphia and have more people living in town who want to come back to the office because it's easy. They can ride a bike, they can jump on the L, they can walk to work, and it's part of their lived experience, just as much as it is going out after work and doing other things. So retention, I think, is going to go hand in hand with reactivating the city and getting more people here, living here, and wanting to be part of the fabric of the community.
Mm-hmm. Yeah. It's interesting. You mentioned at the top of that question, age, and I
Thanks
had
for
read.
reminding me of that.
I don't want to be reminded of it either. I read something recently that Gen Z was actually leading the return to office trend. I don't know what your thoughts are on that, but that Gen Z was leading the trend, and wealthier Gen Xers are the ones that are lagging. So curious what your take is on that. Again, not part of the reason we started this podcast is that not all headlines are true. But it may ring true if you're saying that the people that live closest to their offices are the ones that are going in the city. A lot of these the Gen Z folks are may have started their careers when all we could do was work from home. So I find that to be an interesting dynamic even here, that some of our colleagues started on their couches and spent years on their couches before coming into the office. So what's your take there? What are you seeing?
Well, first of all, I'm at the point where I get confused by what's a Gen X and what's a Gen Z.
I
and
think we
who's
all
what.
are. It's
So,
okay.
so you have to go back to like age groups. But
Right.
let's just assume
Gen
that
Z is very young.
generally speaking, what we're finding is that the older people, partners in law firms, senior management, are starting to appreciate the couch, right? They're like, okay, I can do this from home now. I'm not going to commute. I'm at the point where I'm just going to work from home. I've got my book of business, my clients, and I'm good to go. We are seeing the younger people craving connectivity and craving social environment in addition to work experience. And I think one of the disconnects is that there's a real lack of passing down institutional knowledge and the opportunity to cultivate the next leadership. And speaking to some of our tenants and clients, there is a real fear that in a few years, when those senior people do retire or leave the workforce, that the next generation is not really engaged sufficiently, is not connected to the company sufficiently. It doesn't have the same loyalty, and that there could be a really real problem with maintaining profitability and revenue streams. And so that's something that's on the radar. And I think the growth of AI and the acceleration of more people being able to do, less people being able to do with more, could accelerate this problem.
That's actually another point. I read literally two completely different headlines about AI and its impact on the office space and experience. One specifically noting that in heavily tech-oriented areas, it's driving some demand. Like we don't need to talk about the San Francisco office market in too much detail, but that it's driving a lot of demand. And then on the contrary, I'm hearing one of the headlines I read was that to your point, AI is going to limit some job creation and impact the return to office. So, what are your loose thoughts on that?
So, I think intuitively, most of us recognize that there are going to be some significant benefits and challenges with AI. What was brought home to me yesterday in a conversation with one of the managing partners of a large law firm here in town was his perspective was, and this was volunteered by him just as we were talking. He asked me about AI. He said, I'm trying to learn everything I can about the impact of AI. I'm trying to use it every day. I'm trying to get our attorneys to use it every day. I believe, this is this person speaking, I believe that within the next 5 years, there's going to be a huge upheaval in the legal industry in terms of the use of AI and the repercussions for how many attorneys are needed or associates or support staff, and that there's going to be a sea change in not only our industry, but of all of our clients. So there are people that are now beginning to think through and plan through the implication both in office space demand and headcount and how people are working and operating, that believe that there's going to be another big seismic event in our near future as it relates to demand.
A little bit of early days to make the call on which headline is right there.
Yeah.
Yeah, absolutely. Well, Jim, we've covered a lot of ground here. Again, going back to the purpose of our podcast is giving guests the opportunity to rewrite headlines. So as we start to wrap up, we want to give you that opportunity. What would that ideal headline look like for you? whether it's about the office market or other asset classes that Stockton is engaged in.
Well, I'll probably give a broader headline.
Yeah.
But we've got new leadership in Philadelphia. We've got a new mayor. We've got a new council president. Thematically today and at our CCD Foundation and the Center City District Board, it's time to look forward and not look back, and see what we can take away from the last couple of years in terms of our experience and what's working for Philadelphia. So I guess what I would say is a great headline, or a headline I would hope, is something to the following: new leadership and bold action pave the way for a resurgent Philadelphia. And I think that
Awesome.
hopefully that headline can apply to any number of metro
Any of
areas.
it. Yeah,
Right.
love that.
It's critical that our center cities, our metropolitan areas, are healthy for culture, for diversity, for opportunity. And Philadelphia is at this inflection point where we can decide to think about what's happened in the past, or we can just say it's time to look forward and
Look forward, yeah, look
do
ahead.
some
Yeah.
things that are creative and different.
Yeah,
Perfect.
love that.
I don't think we could have said it better ourselves.
Yeah.
Well, Jim, thank you so much for joining us. It's been a really enlightening conversation. Always love hearing perspectives from people that are kind of out there hitting the streets on a daily basis. So thanks for joining us.
Well, thank you. It was great fun, and I really appreciate the opportunity.
This podcast is a production of Gregory FCA. If you enjoyed our discussion, please subscribe wherever you listen to podcasts